We are looking at this question, which is the question 40, Paladin, and it talks about a company, Serakin, with it acquired on 1st of October 2014, and there is some immediate payment, and there is some deferred payment also, and the cost of capital is given as 8%. So we need to understand basically what is the goodwill calculation for this. So we're looking at that. Second is on 1st of February 2015, Paladin also acquired 25% of equity shares of Augusta, which means that there is one subsidiary and there is an associate also in which the investment is made as per the given information. We're also given the date is of course relevant, 30th September 2015, the balance sheet of these three companies, and then there are some adjustments of course. The requirement is that prepare the consolidated statement of financial position for Paladin as of 30th of September 2015. Now, one thing goes without saying that we are looking at the goodwill calculation on the date of acquisition of the second company, which is Serakin. Right? So, the way we should begin this is we should look at the first working, which is relationship between companies. We're looking at acquisition date, reporting date, percentage holding. Right. So we're given for S and A, we can work like this. Or let's use the names, of course. It is Serakin, and we are given Augusta. The date of acquisition is 1st of October 14, and in the other case it is 1st of February 15. The reporting date is the same for both the companies, so it comes at 30th of September 2015. This date is important because we want to understand how long back was this, what were these companies acquired. The percentage holding is given as okay, we're not given the number straight away, but for the other company, of course, it is 25%. For Serakin, we are looking at 8 million shares, which means that out of 10,000, 8,000 shares were acquired. It means that you're looking at 80% stake in this case, right? Now, the thing that we should be doing is basically looking at the goodwill calculation on acquisition of Serakin. Talking about the purchase consideration, there are two considerations. One is paid in cash, which is 8,000 into 4. That is 32,000. And there's deferred consideration also. And mention that the amount will be paid 5.4 million until 1st of October 2015. So it will only be paid after 1 year since the acquisition date. Since the cost of capital is given as 8%, that can be calculated as 5,400 into 1 divided by 1.08. That will give us an amount of, let's say, 5,000, which means that the total consideration for the 80% stake comes at 37,000, right? We need to obviously take care of, let's say, net assets on acquisition date, which is on 1st of October 2014. We are given the share capital is 10,000 and the retained earnings are 12,000, so we can make a use of that. Share capital of 10,000, retained earnings of 12,000. The question also talks about the fair value adjustments on the date of acquisition. It says that Serakin's property, plant, equipment was equal to the carrying amount, other than the plant, which had a fair value of 4 million above the carrying amount, and also Serakin's customer relationship being an intangible asset of fair value of 3 million, which means that we are talking about, let's say, fair value adjustments for plant is 4,000 and customers relationship is given as 3000, which means that the total assets on the date of acquisition will be 29,000. This to be reduced by, of course, the NCI. NCI is given at the fair value. The first sentence says that 3.50 per share on this date, which means that the remaining shares which are not acquired by parent company, they will be reduced, and accordingly we can say goodwill calculation will come at the difference between these two amounts, which is 15,000. Right, so the first step is over. We've already taken one calculation here. Then of course we need to identify for the post acquisition profits calculations and other adjustments. We are also looking at these unrealized profits, and then there is a talk about the value of investment in Augusta. So now I think let's take it one by one. So I might want to take another working here, which is working 3's unrealized profits. Total sales are made at 30% on cost, right? Which means that if the cost to Paladin is 100, then they are sold at 130. It's given that at 30th September 15, Saracen's inventory included goods bought from Paladin, which costed Saracen 2.6, which means that let's say sale value of the goods is 2600, right? And cost of the goods is 2600 into 100 by 130, which is of course 2000, which means that the unrealized profit, the difference between the two amounts, which is 600, right? There is also mention given of it says that Paladin's aged current account balance owed by Saracen is 1.3, which means that there are intra-group balances of 1300. So we need to take care of that also. I think rest all is clearer, but we just need to identify this value here. So impairment loss for investment in Augusta. It is given as, of course, the loss pertaining to Paladin, which is given as 2500. So we don't need to really make it as a working also, but nonetheless, let's take a major working here. Retained earnings for the three companies: Paladin, Saracen, and Augusta. We are given the profits as per the question. The amounts are, that is 25,700 plus 9,200. So what we do is basically that's 34,900. That is 12 plus 6 is 18, and 31,800 plus 1,200. So we just need to kind of remove less the pre-acquisition profits. That of course is, in this case, is 12,000. Now what we need to remember is we acquired this business on 1st of February. So that gives us the entire February, March, April, May, June, July, August, September. 8 months time after the acquisition date. If the current year's profits are 1200, which means that out of this 800 is the post-acquisition profit, which actually means ideally 33,200 must be the pre-acquisition, that results in, of course, the post acquisition profits are 800. Sorry about that. That's 31,200. Have I missed something? Yeah, I think I have 32,200. That is 800, of course, and likewise this is 6,000. Now we need to split these profits between the parent and the in the respective stakeholders. But before that, there are adjustments we need to take care of. One is the fair value adjustment, plant's remaining value of 4 years, which means that depreciation on plant. Now, since we acquired the business a year ago, which means we are looking at 4,000 divided by 4, which is 1,000. Likewise, we have amortization of intangible asset. It is given that the asset's value is 3,000 and the life is 6 years, which means that we should be looking at it 3,000 by 6. The dates are important, so we look at this charge coming in. Now, it says that Serican sold some goods on which there was an unrealized profit, which means that above working, of course, we have done that. We just need to give a reference of that also. Let's see what this working number. I think it is 3. Yeah. So the working number 3's reference comes in here. Okay. Because Serican sold it, that's the reason why it should be taken at in the books of, let's say, Serican. Is there anything else? Is an impairment loss of 2,500. Of course, this impairment loss has to be borne by the parent company for the investments made in Augusta, right? So we have got these amounts. The total will come at these amounts respectively, and out of this, of course, talking about Paladin's share, 80% in Serican, and NCI's share is 20%. Of course, that would come at 780. Likewise, we have Paladin's share in Augusta, which is 25% of the post-acquisition profits, which comes at 200. So the group retained earnings are measured as 35720. Right? Is it okay? Now there is one context which is there, which I would want to highlight, which is basically about your finance. The finance cost of this deferred consideration. That is something which I missed. So since this consideration has to increase over a period of time, right? And we are talking about the consideration to be paid is on 1st of October 15, which means that this 5,000 has to increase from 5,000 to 5,400, right? Which means that this deferred consideration, the cost of deferred consideration, obviously because of the time gap, has to be charged to which is 5,000 into 8%. So that is being charged to, of course, the parent company, which comes at 400. So effectively the profit figure will change. Is it okay? Right. So with this amount, we can move forward and we look at, let's say, the NCI's value also. That could be working 6 here. I'm given the opening balance, of course, at the time of goodwill calculation, which is 7,000 here. and share of profits, of course, in 780. That gives my NCI on reporting data 7780. Now finally I'm looking at the workings or for the investment in Augusta. I'm given the opening balance. At what value did we acquire the investment? It says 10 million, which is 10,000. Of course, there is a share of profits in Augusta. There is working retained earnings. We calculated that it comes at 200, but of course it is reduced by impairment loss. That is also calculated working 5. Well, it might not be even shown like that. So the investment in Augusta is to be taken to the value of, let's say, 7,700. Are you okay with that? Yeah. So with the above figures, we can simply kind of go ahead and prepare a balance sheet. So consolidated. So as at 30th of September 2015 will be calculated like this. So when we look at the balance sheet, of course, we need to kind of combine the numbers. And I can simply use the same format as given in the question here. So assets, within that I'm looking at the balance sheet, property, plant and equipment. It's given that it's 40,000 plus 31,000, of course. If you remember, we had the plant worth 4,000 adjusted for the depreciations. These are the workings that I would want to kind of quote as a part of the calculation. So it becomes 74,000, of course, right? Likewise, we have goodwill that we calculated in working 2. This can simply be picked. It was 15,000, and remember the figure, but let's take it here. And other than that, I also had intangible assets, which is okay. They are given intangible assets already, so 7,500 plus 3,000 minus 500. Right. This is about that customer relationship, which is there. Finally, investment in associates. We've done that calculation already, so I think it's working 7 maybe. It's given, the value is given here, of course, that is there. You probably can't take it from here itself. 7,700. Right. Now I'm looking at the second part, which is current assets. Inventory, I'll add the inventory for both the companies, which is 11,200 plus 8,400 minus that unrealized profit. This gives me a value of 19,000. Receivables are given at 7,400 plus 5,300 minus that 1,300, which was the intra-group receivable. That gives us 11,400. And finally, I have a bank balance, which is straight away given 3,400, so I don't need to kind of show it separately. That gives me total assets of 140,500. Finally, I'm looking at the equity and liabilities. Share capital only of the parent company, of course, which comes at 50,000. Retained earnings, I'm given as per the working 5, I think we calculated that. That is 5320. Then I'm looking at the non-controlling interest. Working 6, we also calculated this earlier. You can pick it up as 7780. Then I'm given the non-current liabilities and then current liabilities, etc. Non-current liabilities, that is deferred tax. Amounts are 15 plus 8. That is 23,000. Current liabilities, there is a bank overdraft, which is 2,500. Payables, we have to eliminate that intergroup. Rest all is okay. So 11,600 plus 6,200 minus 1,300. That gives the value of 16,500. And there is a deferred consideration, which is payable the next day itself, right? Which is 5,000 plus 400. 400. That gives me total equity and liabilities of 140,500. Right? Okay, there is more correction that we would like to make on this. This unrealized profit, basically the sale is made by the parent company and not the subsidiary. So basically the way it is going to work is, I think that's all the adjustments would remain same, but yeah, of course the balance sheet must have been tallied on this. It does tally. So that's the only change which comes in, because the sale is in fact made by Paladin to Serican. So this unrealized profit has to go out of the profits of the parent company, right? Not the subsidiary company. So I think this one, want to check that. Here we go. Right. So yes, that is how our balance sheet is getting tallied. Are we okay with that? Yeah. Great.